So how can you reduce employment taxes with an S corporation? If you're self-employed, you'll usually have to pay higher Social Security and Medicare taxes, collectively known as self-employment taxes. One way to help avoid these higher taxes is to organize your business as an S corp. First, you pay yourself a salary. Then, you will only pay self-employment taxes on the salary that you pay yourself. And you won't pay it on all of your business revenue. You can then pay yourself on the remaining amount as distributions from the S corporation, and not have to pay self-employment taxes on those distributions. So, an S corporation is the best entity type for reducing self-employment taxes. Let's say you're a shareholder employee of an S corporation, and the company's net profit is $100,000. So in this example, let's say the company pays you a $36,000 W-2 salary. Then, the company will have a $64,000 profit after deducting your W-2 salary. While your W-2 salary will be subject to employment taxes, the $64,000 profit of the S corporation is pass-through income. This is important because the pass-through income of an S corporation isn't subject to Social Security or Medicare taxes, saving you 15.3% in employment taxes. So then, you'll be able to reduce your employment taxes with an S corporation by paying yourself a lower salary. So then, what are the risks of using an S corporation? The IRS tends to take a closer look at S corporation returns, since the potential for abuse is so large. So for example, let's say this time you make $500,000 profit in 1 year, but only designate $36,000 of that as W-2 income. That could raise a red flag, because then you would be avoiding way too much self-employment tax. The guiding principle is that you must designate a reasonable amount of your income as W-2 wages. Otherwise, you could be treating too much of it as distribution. So what constitutes as reasonable W-2 wages? That can often be a gray area. But if you push the envelope too far, then you could put yourself at risk for an IRS audit. So, what are the additional costs for S corporations? While an S corporation may save you in self-employment taxes, it may cost you more than it saves. As with any business entities, S corporations have both startup and ongoing costs. In some states, S corporations must also pay additional fees and taxes. For example, in California, an S corporation must pay tax of 1.5% on its profits, with a minimum annual amount of $800. But this tax is not required for sole proprietors. Hopefully, this information will be useful when determining if an S corporation is the right fit for you. Click the link below to schedule an appointment and get your free consultation so we can set up your corporation today.